All right, let's dive in. Today, I want you to forget everything you know about being an investor. Instead, I want you to put on your consultant hat. We've got a client and we've got a case to figure out how a mutual fund really works from the inside out. This isn't about picking hot stocks. It's about understanding the machine itself. So, let's get to it. So, here's our prompt. This is the case question. Your client walks in, puts their trust in you, and says they're thinking about a mutual fund. Where do you even begin? Before you can talk about performance or what the fund owns, you need a process, right? A structured way to look at the very foundation of any fund. It's not about finding a winner just yet. It's about making sure the engine is built right before we even turn the key. And here is our game plan. Every good consultant needs a framework, and this is the one we're going to use. First, we're going to kick the tires on safety. Then we'll figure out how easy it is to get your money in and out. That's liquidity. After that, we'll pull back the curtain on how these things are priced every single day. And finally, and this is a big one, we are going to expose the hidden drag on performance that can make or break your client's long-term goals. This is our roadmap. Let's follow it.
Okay, first things first, security. Before we even start dreaming about returns, we have to know with absolute certainty that the client's money is safe. Is it protected from somebody just walking away with it? So our analysis has to start with that one simple question. How secure is the vault?
The secret to a mutual fund's safety isn't some crazy complex technology. It's actually a pretty brilliant and simple idea. Separation of powers. The whole system is designed so that no one single company, no one person, holds all the keys to the kingdom. It's all about checks and balances. And that right there is the foundation of how investors are protected.
Let's think about this like a high-security operation, okay? The sponsor, they're the architect. They draw up the blueprints for the fund. Then you have the asset management company, the AMC. These are the pros, the operations team that actually manages the money day to day. But, and this is so important, they are always being watched by the trustees. The trustees are like a team of independent auditors. Their only job, their only legal duty is to look out for the investors.
And right here, this is the absolute linchpin of the entire system. The AMC, the team making all the buy and sell decisions, never actually touches the assets. The stocks, the bonds, all of it, it's held by a totally separate, highly regulated bank called the custodian. So the fund manager can give the orders, but the custodian holds the keys to the vault. This one single feature is what protects your client's money from just disappearing. It's a huge deal.
So, we've established the money is secure. Great. But what about getting it back? The next big question we have to answer for our client is all about liquidity. How quickly and easily can they get their cash if they need it? And the answer to that really comes down to the fund's basic design. And basically, there are two main flavors. Most funds you hear about are open-ended. That means you buy and sell your shares directly from the fund company itself at a price that's calculated just once per day. It's super simple and super liquid. But then there are closed-ended funds. These are a whole different animal. They issue a fixed number of shares, and then those shares trade on the stock market all day long, just like a stock. And that means getting your money out depends on finding someone else who wants to buy your shares.
Now, because a closed-ended fund's price is driven by the whims of the market, something really fascinating can happen. Its share price can actually drop below the real value of all the assets it holds. This is called trading at a discount. And what that means in plain English is you could have the chance to buy $1's worth of assets for, say, 90 cents. As a consultant, you'd immediately flag this as a potential opportunity, but one that definitely comes with its own set of risks.
Okay, time for piece number 3 of our puzzle. We keep throwing around this term, this official price tag, the net asset value, or NAV. So what is it exactly, and how in the world is it calculated so precisely every single day? Understanding this is the key to tracking what's really going on with a fund's performance.
It's actually a really straightforward accounting drill. Every day when the market closes, the fund's accountants tally up the final value of every single thing the fund owns. They add in any income, like dividends, that came in that day. Then, and this is a really important detail, they subtract a little tiny slice of the fund's annual fees. After they take care of any other debts, they take that final number and divide it by all the shares out there. And boom, that's your NAV for the day.
Now, this is a point I really want to hammer home. A fund with a $10 NAV is not, I repeat, not cheaper or a better deal than a fund with a $100 NAV. The price itself is basically meaningless. The only thing that matters, the only thing that affects your client's wallet is the percentage change.
A 10% gain is a 10% gain, whether you go from $10 to $11 or from $100 to $110. It's all about the return.
And that brings us to our final and honestly, probably the most critical framework. We just saw that costs are quietly taken out every single day before that final NAV number is even calculated. That makes them this silent, invisible force that's constantly pulling down performance. So our job as consultants is to drag those hidden costs out into the light.
So all these costs get bundled into one simple number, the total expense ratio, or TER. This chart shows you what you're paying for. The biggest chunk usually is the management fee. That's what you pay the investment team. Then you've got these things called distribution or 12B1 fees, which is mostly marketing and sales costs. And finally, you have all the other nuts and bolts like legal and accounting. It all adds up little by little.
And this chart shows you exactly why you have to obsess over that little percentage for your client. Just look at the destructive power of fees over time. If you invest $100,000 for 20 years with a low fee like 0.25%, you end up with about $208,000. Not bad, but look what happens with a 1% fee, just 0.75% more. Your final number is only $179,000. That's a $29,000 difference. Poof, gone, eaten up entirely by costs.
All right, case closed. Now it's time to prep for that final client presentation or, maybe that big MBA job interview. Let's boil everything we just learned down into a few sharp, powerful takeaways.
So here they are, the 3 things you absolutely need to remember. 1, the system is built for safety, and that independent custodian is the real hero of the story. 2, liquidity is a choice. You could have the easy access of an open-ended fund or the potential opportunities of a closed-ended one, but they are very different. And 3, costs are everything. The expense ratio is the single best clue you have about what your future returns will actually look like. Your job is to find the lowest cost option for any given strategy. Okay, let's practice. First interview question. To nail this, you'd start by talking about that 3-part separation of duties: sponsor, trustees, and AMC. But the real A+ answer, the detail that shows you really get it, is when you explain the role of that independent custodian. The manager gives the orders, sure, but the custodian holds the assets. That makes it incredibly hard for anyone to just run away with the money.
This one's a bit tougher. The opportunity is easy, right? It's a chance to buy a dollar's worth of assets for just 85 cents. The risk, though, is a little more subtle. For one, there's no law that says that discount has to disappear. It could get even bigger. And second, the fact that there's a discount might be a warning sign about the fund itself. Plus, your ability to sell depends entirely on finding another buyer, which is a classic liquidity risk.
And for our final question, this one really gets to the heart of our entire analysis. The answer is all about certainty versus uncertainty. A fund manager's amazing performance last year, well, that's no guarantee of what they'll do next year. Past performance does not equal future results. But costs? Costs are a mathematical certainty. They are a guaranteed drag on performance, every single day, year after year. And in the long run, the certainty of keeping costs low will almost always win against the hope of finding a star manager. Something to really think about.